Hello ladies and gents. In this short video, I'm going to show you how saving $1,000 a month into a properly structured IUL can set up for tax-free retirement can turn into $100,000 a year for tax-free retirement income. And I'm also going to show you how to avoid 3 massive mistakes that most people make when getting an IUL. But first, let me briefly explain how an IUL actually works. See, whenever you make a contribution, your contribution is divided into 2. The death benefit and the cash value. The cash value is essentially where you're going to be able to pull from for your tax-free retirement. It builds compound interest that's linked to the stock market and that grows over time. On the other side is your death benefit. The death benefit is what's going to go to your family in the event when you pass. If you want it set up for tax-free retirement, you actually want to put the least amount towards the death benefit and the most going towards your cash value. The problem is that if it's structured for the death benefit, less is going towards for your retirement. So whoever sets it up actually gets paid more if they set it up for the death benefit rather than the cash value. So what you want to do is you want to put the least amount towards the death benefit and then the most going towards the cash value. So in this case, if you're contributing $1,000 per month, $800 is going towards the death benefit. Majority of the focus is going towards the death benefit, and then only $200 is going towards the cash value. Over time, your money is going to grow in the cash value bucket, but it's just not going to grow as aggressive because majority of it is structured going towards the death benefit. When it comes to agents that set it up improperly, it could be that they're either ill-advised or they're unethical because they get paid more if they structure it for the death benefit. If you want to set it properly for tax-free retirement, then what you want to do is you actually want to do the opposite. You want to put $200 towards the death benefit and then $800 going towards the cash value. Some people ask, well, can you just put everything towards the cash value and nothing towards the death benefit? It doesn't work like that. Because where your money is parked, it has to have some life insurance to be able to access those tax-free advantages. You want to put the least towards the death benefit so that you're able to access those tax-free advantages. The other reason why people are talking about this is because of indexing. Indexing is basically right here. This is what would happen if you have your money in an IUL or a tax-free retirement account. Whenever the stock market does well, you're going to see a portion of the gains, but whenever the stock market does bad, then you're going to be protected at all times. This black line right here is if you have your money in a qualified plan such as a 401k or IRA. Yes, you're going to get all the gains in the market, but you're also going to get the dips. When you have your money in an IUL, you're going to get a portion of the gains. But whenever the stock market crashes 2008, you have a guaranteed floor that's protecting your principal at all times. Some of your friends that may have a 401k, they're happy when the stock market performs well, but then they're crying when the stock market drops. But if you have your money in an IUL, whenever the money drops, you're going to be protected. Some of you may be asking, well, this is too good to be true. The reason because you're going to see a portion of the gains. Those are the cap rates. So for different financial institutions, they have different cap rates. They usually range from about 8 to 10%. For example, if the stock market goes up to 12%, you're only going to receive 10%. But if the stock market dips low and crashes, with the IUL, your money is always going to be protected. Whenever the stock market drops, this black line right here, like a dot-com crash, if you go to retire during those years, you're either going to lose half of your retirement income because the stock market dropped, or you're just going to have to keep working until the stock market rises again. Like the housing crash in 2008, the COVID crash in 2020. This is an example of one of our clients that's contributing $1,000, a little bit over $1,000 a month, and they're able to access a little over $108,000 per year when they go to retire. And some of you might be asking, well, why hasn't my financial advisor told me about this? Well, most financial advisors don't actually specialize in IULs. They don't make money on IULs, and they only make money on stock market based options in your portfolio. There's also 3 massive mistakes to avoid when setting up an IUL. Is trying to use it to get rich quick. If you think if you put in $50 today and then tomorrow become a millionaire, it doesn't work. It takes time for your money to compound and grow and marinate for then you to be able to access it tax-free. This is a long-term savings plan. Not paying attention to the cap rates. As I mentioned, some financial institutions have cap rates on the low end at 8%. On some instances, other institutions have cap rates at 12%. So make sure that you're paying attention to those cap rates. And then lastly is setting up your IUL incorrectly. If you want it set up correctly and you're having it, majority of your IUL is going towards the death benefit, then as I mentioned earlier in the video, then only 20% of it is going towards the cash value. So you want to do the opposite. You want to put the most towards the cash value and then the least towards the death benefit. So next steps, fill out the form below this video, book a consultation on the next page, and I will create a custom illustration to show you how much tax-free retirement you qualify for.